Hello, friends. There are three changes affecting American seniors right now in June 2026 that represent real financial wins, and most people have either not heard about all of them or have heard about them without understanding what specific action is needed to capture the full benefit. I want to walk through each one clearly, explain exactly who it helps, what the dollar value is, and what you need to do today to make sure you are not leaving any of it behind. My name is Linda Foster. I have spent 12 years as a certified retirement planner, and these three changes are the ones I am talking about with every client right now because the combination of them, for the right household, can add thousands of dollars per year in net income permanently. Change number one, the Social Security COLA increase and how to make sure you are getting the full amount. In January 2026, Social Security benefits increased by 2.8% for every recipient. For the average retiree receiving $2,015 per month, that increase was approximately $56 per month, bringing the average check to approximately $2,071. That is the headline number, but here is the reality that most people discovered when their January deposit arrived. The net increase was significantly smaller than $56 for most Medicare-enrolled seniors, because the Medicare Part B premium also increased simultaneously. The Part B premium rose from $185 per month in 2025 to $202.90 in 2026, an increase of $17.90. For a senior receiving exactly the average benefit, the net increase after the Medicare premium rise was approximately $38.10. Not $56. For seniors who also pay IRMAA surcharges on Medicare because their income exceeded certain thresholds 2 years ago, the net increase may have been even smaller, or in some cases, the surcharge increase may have partially or fully offset the COLA. The action item from this change is specific. Check your actual January 2026 deposit amount and compare it to your December 2025 deposit. The difference tells you your actual net increase. If your net increase was significantly smaller than expected, or if you are paying an IRMAA surcharge based on 2024 income that no longer reflects your current financial situation because you retired or your income dropped, you may be able to recover some of that lost ground. For anyone paying an IRMAA surcharge based on higher prior year income, Form SSA-44 is available at SSA.gov and allows you to report a life-changing event, including retirement, and have Medicare recalculate your premium based on current income. Eliminating a Tier 1 IRMAA surcharge recovers $81.10 per month. Eliminating a Tier 2 surcharge recovers $202.40 per month. Those amounts, added to your net Social Security deposit permanently, are meaningful for any senior on a fixed income. That is change number one. Change number two, the senior bonus deduction and the refund many seniors are still waiting for. The One Big Beautiful Bill Act of 2025 created an additional federal tax deduction of $6,000 for every person 65 or older, or $12,000 for married couples both over 65. This deduction applies to the 2025 tax year, the return most seniors filed earlier this spring. According to Treasury Secretary Scott Bessent, Trump's Working Families tax cuts delivered historic tax relief to over 35 million seniors. The senior bonus deduction is the core of that relief for retirees. The deduction reduces your taxable income. For a single senior in the 22% federal tax bracket, $6,000 of additional deduction produces $1,320 in additional tax saving. For a married couple both over 65 in the same bracket, $12,000 of deduction produces $2,640 in tax saving. For seniors with more modest incomes whose taxable income after the standard deduction and the existing senior addition was already low, the senior bonus deduction may have pushed their 2025 federal tax liability to zero, making every dollar of federal income tax that was withheld from their Social Security check during 2025 a recoverable refund. Here is the June 2026 specific issue. The 2025 tax filing deadline was April 15th. Most seniors have already filed, but a meaningful number filed without the senior bonus deduction being correctly applied. either because their preparer was not yet fully familiar with the new law, or because basic tax software did not flag the change. If you filed your 2025 return and are not certain whether the deduction appears, contact your preparer and ask specifically whether the enhanced senior deduction of $6,000 or $12,000 is reflected on your return. If it was missed, an amended return on Form 1040-X recovers the refund. The deadline to amend a 2025 return is April 15, 2029, so there is time. But every month you wait is a month the refund is not in your account. Additionally, if you are currently having federal income tax withheld from your Social Security check using the W-4V form, recalculate your actual 2026 tax liability after applying the senior bonus deduction. If the deduction reduces your liability to near zero, stopping the withholding by filing a new W-4V returns that money to your monthly deposit going forward. That is change number 2. Change number 3, the Medicare Part D out-of-pocket cap and why June is when it matters most. Starting in 2025 and continuing in 2026, all Medicare Part D prescription drug plans have a hard annual cap on out-of-pocket spending. In 2026, that cap is $2,100. Once you have spent $2,100 out of pocket on covered Part D drugs during the calendar year, your cost for covered medications drops to zero for the remainder of the year. This is one of the most significant improvements to Medicare drug coverage in decades. Before the cap existed, seniors taking medications for cancer, diabetes, heart disease, or autoimmune conditions could spend $8,000, $10,000, or more dollars per year on medications. That exposure is now capped at $2,100. Here is why June specifically matters. The cap resets on January 1st of each year. Seniors who take regular medications, particularly those with higher cost prescriptions, often hit the cap by late spring or early summer. If you have been paying for medication since January, June is the month when many seniors are approaching or have already crossed the $2,100 threshold. Contact your Part D plan this week and ask for your year-to-date out-of-pocket spending total. Most plans also show this in the member portal. If you have already spent $2,100 on covered drugs this year, every covered prescription you fill for the rest of 2026 should cost you nothing at the pharmacy. If the pharmacy is still charging you after you have crossed the cap, call your plan immediately. If you have not yet reached the cap, but you are on medications that will take you close to it by year-end, October is the time to use Medicare's Plan Finder at medicare.gov to compare Part D plans for 2027 based on your specific drug list. The plan that costs least for your specific medications may not be the one with the lowest monthly premium. And if your income is below approximately $22,000 as a single person or $30,000 as a couple, the Extra Help program through the Social Security Administration may eliminate most of your drug costs entirely. Apply through SSA.gov or by calling 1-800-772-1213. That is change number 3. Let me close by connecting all 3 changes to the single practical step that matters most right now. Check 3 numbers this week. Your actual January 2026 Social Security deposit compared to December 2025 to understand your real net COLA. Your 2025 tax return to confirm the senior bonus deduction was applied. And your year-to-date Part D spending to see where you stand relative to the $2,100 cap. 3 numbers, 30 minutes, potentially hundreds to thousands of dollars in captured benefits that are yours by right and by law. Send this video to one senior in your life who has not checked any of these 3 numbers since January. I will see you in the next one. Let me go deeper on each of the 3 changes because the practical details determine whether you actually capture the benefit or leave it behind. On change number 1, the COLA and IRMAA interaction, I want to address the specific situation of seniors who retired in 2023 or 2024 and are paying surcharges based on their final working year income. Medicare uses a 2-year look-back. Your 2026 premiums are based on your 2024 tax return. A senior who retired in mid-2024 and had a 2024 income of $140,000 from their final months of employment is potentially paying a Tier 2 IRMAA surcharge of $202.40 per month in 2026, based on income they stopped earning 18 months ago. The Form SSA-44 process requires you to identify the life-changing event, which is work stoppage or reduction, and provide documentation of your retirement date and current income. Acceptable documentation includes your final pay stub, a letter from your former employer confirming separation, your pension benefit statement, or your most recent tax return showing your current income level. Once the SSA processes your SSA-44, they recalculate your Medicare premium based on the income information you provided, rather than the 2024 tax return figure. The new premium takes effect typically within 60 to 90 days of submission. Every month between now and when the recalculation takes effect, you continue paying the surcharge. This is why filing promptly matters. I want to specifically address one common misunderstanding about the IRMAA surcharge. Some seniors assume that once they filed their 2025 tax return showing lower retirement income, Medicare would automatically recalculate their 2026 premiums. This is incorrect. The 2-year look-back means your 2025 return will affect your 2027 premiums, not your 2026 premiums. The SSA-44 is the only mechanism to request recalculation before the normal 2-year cycle would produce the adjustment. On change number 2, the senior bonus deduction, I want to address the interaction with the Social Security taxation thresholds, because this is where the deduction produces additional value beyond its face amount. The Social Security taxation formula calculates your combined income as your adjusted gross income plus non-taxable interest plus half of your total Social Security benefits. If this combined income falls below $25,000 for a single filer or $32,000 for a married couple, none of your Social Security is taxable. The senior bonus deduction reduces your adjusted gross income. For a single senior whose combined income without the deduction is $27,000, the $6,000 deduction reduces their AGI by $6,000, bringing combined income to $21,000. They have crossed below the $25,000 threshold. Their Social Security is now entirely tax-free. In this scenario, the financial benefit of the senior bonus deduction is not just the direct tax saving on the $6,000. It is also the tax saving on whatever portion of Social Security was previously taxable. If this senior was paying tax on $4,000 of Social Security at 22%, the threshold crossing eliminates $880 additional dollars in tax. The total benefit of the $6,000 deduction is $1,320 direct plus $880 Social Security, totaling $2,200. Significantly more than the face value calculation of the deduction alone. This multiplier effect is why understanding the complete interaction of all income items is so much more valuable than looking at any single number in isolation. On change number 3, the Part D cap, I want to address the specific situation of seniors who take expensive specialty medications, because these are the people for whom the cap has the most dramatic impact. Before the $2,100 cap existed, seniors taking specialty medications for conditions like rheumatoid arthritis, multiple sclerosis, Crohn's disease, or certain cancer treatments faced catastrophic out-of-pocket drug costs each year. A single specialty medication might cost several $100s per month in cost sharing, producing several $1,000s in annual out-of-pocket costs. Under the $2,100 cap, a senior taking one of these medications who reaches $2,100 in total out-of-pocket spending by, say, April, pays nothing for all covered medications from April through December. That is 9 months of medication at zero cost. The critical action for this group is to ensure their Part D plan covers their specific specialty medication. Part D formularies, the list of covered drugs, change each year. If a medication is not on the formulary, it does not count toward the out-of-pocket cap and may require a separate prior authorization process. Checking the formulary for your specific medications during the October open enrollment period ensures you are in a plan that covers what you need. Also worth knowing for higher cost medication users, the manufacturer assistance programs that provided additional discounts before the cap existed may now interact differently with the Part D structure. Some pharmaceutical manufacturers no longer offer copay cards or patient assistance for commercially insured patients because the cap reduces financial need. If you were receiving manufacturer assistance in prior years, and that assistance has changed, understanding how the new cap structure affects your total costs is worth a conversation with your pharmacist or plan. Let me also address the specific situation of seniors who are approaching Medicare eligibility for the first time in 2026, because the three changes I described apply to them from their first day of coverage. If you turn 65 in 2026 and are enrolling in Medicare for the first time, the $2,100 Part D cap applies to you from the first day of your Part D coverage. You do not need to have been on Medicare in prior years to benefit. The senior bonus deduction applies to your 2025 and 2026 tax returns, regardless of when you enrolled in Medicare. And understanding the IRMAA structure from your first year of Medicare enrollment prevents the common surprise of discovering a surcharge after the fact. For new Medicare enrollees, the decision about which Part D plan to select is worth spending an hour on Medicare's Plan Finder at medicare.gov. Entering your specific medications produces a ranked list of plans by total estimated annual cost, including both premiums and drug costs. The plan with the lowest monthly premium is frequently not the plan with the lowest total annual cost for a given drug list. The Plan Finder makes this comparison immediately visible. One final point that connects all three changes together. These benefits all require you to know they exist and to take a specific action. The COLA arrived automatically, but the IRMAA recalculation requires you to file the SSA-44. The senior bonus deduction is available on your tax return, but only if the preparer or software applied it correctly. The Part D cap applies to covered drugs automatically, but knowing when you have hit it requires checking your year-to-date spending. None of these benefits sends you a notification when you are entitled to more money. The notification is this video. The action is yours to take. I will see you in the next one. Let me address several additional dimensions of these three changes that are particularly relevant for specific groups of seniors. On the COLA and net income picture, I want to address the situation of seniors who are receiving Social Security disability insurance rather than retirement benefits. The 2.8% COLA applies equally to SSDI recipients. The same Medicare premium dynamics apply, and the same IRMAA rules apply if income triggers a surcharge. For SSDI recipients who have not yet converted to retirement benefits at full retirement age, understanding that the COLA applies to their current benefit and that the net increase is reduced by the Medicare premium rise is equally important. Additionally, for SSI recipients, the 2026 COLA applied to the federal SSI maximum as well. The federal SSI maximum for an individual in 2026 is $967 per month. For a couple, it is $1,450 per month. SSI recipients who also receive a small Social Security benefit or have other income sources need to understand how the COLA interacts with the SSI income calculation. Each dollar of Social Security income above certain disregards reduces SSI by 75 cents. Understanding your specific income mix and how the COLA affects your total monthly income from all sources is worth a call to the Social Security Administration if you receive both SSI and Social Security. On the senior bonus deduction, I want to address the specific situation of seniors who use tax preparation services at major chains versus those who use independent preparers or CPAs. The major tax preparation chains updated their software to reflect the senior bonus deduction for 2025 returns. However, the quality of the explanation provided to clients about this deduction varied significantly across chains and individual preparers. Some clients received a clear explanation of the new deduction and its value. Others had it applied without any discussion, and a smaller number had it missed entirely, particularly in early season filings completed before preparers had fully absorbed the new law. If you used a major chain or a storefront preparer for your 2025 return, and you did not receive any specific discussion about a new $6,000 or $12,000 deduction, that is worth following up on. Call the same office and ask whether the senior bonus deduction was applied to your return. If they say they are not familiar with that deduction by name, ask them to look at your Form 1040 and tell you what the deduction amounts are on the relevant lines. For seniors who file their own returns using tax software, the deduction should appear automatically when your date of birth is correctly entered and the software has been updated. If you used an older version of software that was not updated before you filed, the deduction may have been missed. Again, checking the relevant lines on your filed return and amending if necessary is the action. I also want to address the 4-year window for the senior bonus deduction specifically, because this creates a planning opportunity that is particularly relevant for higher income seniors who are at or above the income threshold where the deduction phases out. The deduction phases out at 6% per dollar above $75,000 of modified adjusted gross income for single filers and $150,000 for couples. At approximately $150,000 for a single filer, the deduction has phased out entirely. For couples, it phases out at approximately $350,000. For seniors near the phase-out boundary, the years 2025 through 2028 represent a specific window in which income management can preserve the full deduction. Strategies that reduce MAGI below the threshold, including qualified charitable distributions from IRA accounts, timing of capital gains realizations, and management of discretionary IRA withdrawals, can preserve some or all of the deduction in years where income might otherwise exceed the threshold. For a senior whose income typically sits at $80,000 and who has some flexibility in the timing of IRA withdrawals or investment income, keeping income below $75,000 in 2026 through 2028 to claim the full $6,000 deduction produces $1,320 per year in tax savings, or $3,960 over the 3 remaining years of the deduction window. The planning conversation with a tax professional to achieve this is worth having before the end of each calendar year. On the Part D cap, I want to address the interaction with Medicare Advantage plans specifically, because a significant number of seniors receive their drug coverage through a Medicare Advantage plan with drug coverage rather than a standalone Part D plan. The $2,100 out-of-pocket cap applies to Medicare Advantage plans with drug coverage, as well as standalone Part D plans. However, Medicare Advantage plans can have their own cost-sharing structures for drugs that differ from standalone Part D plans, and the way costs accumulate toward the cap may differ depending on the plan design. For seniors in Medicare Advantage plans, confirming with your plan how costs accumulate toward the $2,100 cap and what your year-to-date spending is requires contacting your specific plan rather than checking the standalone Part D portal. Many Medicare Advantage plans have member portals that show year-to-date drug spending. Your member card or the back of your plan document includes the member services number. Also worth noting for Medicare Advantage members, the annual open enrollment from October 15th to December 7th allows you to switch from a Medicare Advantage plan to Original Medicare with a standalone Part D plan, or to switch between Medicare Advantage plans. If your current plan's drug coverage is not meeting your needs, the October window is when you can change. Using the Medicare Plan Finder during that window to compare total estimated annual costs, including drug costs for your specific medications, helps identify whether a different plan structure would serve you better in 2027. Let me bring the complete June 2026 picture together with the specific action checklist I want you to complete before this month is out. First, compare your January 2026 Social Security deposit to your December 2025 deposit. Note the actual net increase. If you are paying an IRMAA surcharge and your income has decreased significantly since 2024, download Form SSA-44 from SSA.gov and begin the recalculation process. Second, confirm that your 2025 federal tax return included the senior bonus deduction of $6,000 if you are single and over 65, or $12,000 if you and your spouse are both over 65. If it was missing, contact your preparer or prepare to file Form 1040-X. If you are currently withholding federal income tax from your Social Security check, Recalculate whether your actual 2026 liability after the deduction justifies the current withholding rate. Third, contact your Part D plan or check your member portal for your year-to-date out-of-pocket drug spending. If you have reached $2,100, confirm that your pharmacy is not charging you for covered medications. If you have not reached the cap but are on medications that will take you close, mark October 15th on your calendar as the start of open enrollment to compare plans for 2027. These 3 actions are specific, time-bounded, and directly connected to money that is either yours already or that you can capture through a single form or a single call. The June timing matters because the Part D cap progress check is most relevant mid-year. The IRMAA recalculation saves you money for every remaining month of 2026, and the senior bonus deduction refund from an amended return comes back faster if you file the amendment sooner. The 3 changes are wins. Capturing them fully requires knowing the specific action each one demands. I will see you in the next one.